Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 5, Corporate Capital Budgeting. In this topic, we're going to talk about the process of capital budgeting and using NPV and IRR to measure the value of these projects. When we talk about capital budgeting is the process of selecting what investments a firm will undertake in a given year. The NPV and IRR are the two primary measures. In this topic, we're going to calculate the NPV and IRR of revenue-producing investments, cost reduction investments, lease versus buy decisions, accelerated depreciation versus straight line depreciation, outsourcing decisions, and investments of projects that have unequal lifespans. We'll also talk about when it's appropriate to use WACC as your NPV and IRR discount rates. And then we'll talk about other measures and which measures to use ultimately to determine which projects to accept. So let's talk about the process of using NPV and IRR. For most of the examples we're going to use in this course, we're going to use free cash flows to the firm. Those are cash flows available to pay both debt and equity holders, so by definition they don't include any interest expense or dividend payments. So it's cash flows being generated by the operating assets of the firm that are available to pay the capital providers. Now we could use free cash flows to equity, which would first subtract out the interest expenses. However, the free cash flows of the firm is generally preferable because it doesn't require forecasts of debt and interest, which then requires you to have a long-term strategy and short-term strategy of capital structure. Now the actual tax benefits of actual debt financing are captured inside the NPV and IRR. However, they're captured inside or in the weighted average cost of capital. Now, generally, people talk about if I'm going to evaluate a project for a firm, maybe to open a new store or launch a new business line, what you'll generally use is the weighted average cost of capital, the cost of capital of the firm. And that makes perfect sense. If a firm can get access to capital from bondholders and banks and from equity holders, and they demand, say, a 15% return after tax, that's what our WACC is, you would expect that all projects must have a 15% return. And that's generally what we'll use for many investments, is the weighted average cost of capital. However, this is only going to be appropriate when evaluating a project or an investment which has the same risk or very similar risk as the actual firm. So for example, if Walmart wanted to open another store in your hometown, they should use their weighted average cost of capital as the NPV discount rate and the IRR hurdle rate. For the reasons we talked about before, that is their cost of capital. They want to make sure they exceed that. Also, one of the principles is the NPV and IRR discount rate should really reflect the risk of the project. However, to the extent that the cost of capital, the weighted average cost of capital, is the risk of the firm, because equity holders and bondholders assess the firm's risk and they'll demand a certain rate of return. So really, the weighted average cost of capital reflects the risk associated with the firm's business. Therefore, the projects that you're evaluating that have the same risk of the business, again, opening a new store, launching a new product line within your industry, should use the weighted average cost of capital. However, when you do not use the weighted average cost of capital is when the project has a very much different risk than the actual firm's business. For example, all you want to do is replace a copier, and you're looking at two different copiers. And you want to calculate an NPV of doing that project, making that investment. It seems unfair to use the weighted average cost of capital because that project seems like it's almost risk-free, right? You'll know exactly the cash flows to buy a copier, and you might know the expenses of one copier versus another. So the cash flows are in some sense risk-free versus, say, opening a new store. So you can make an argument that an investment in, say, an infrastructure project, something not related to the business, the basic industry risk, could be discounted at a risk-free rate of return if the cash flows are certain. Now, in practice, what firms will often do is use the after-tax cost of debt. Because those projects aren't exactly risk-free, they're nearly risk-free. So an after-tax cost of debt is a proxy for kind of a low-risk project in the firm. So if Walmart wants to open a new store, I would use the WACC as the discount rate. If Walmart has a decision it would like to, say, replace their traditional electrical power sources with solar power as a trial in a single store, I would not use the WACC because that project's going to be relatively risk-free. You're going to know exactly what it cost, and you'll be pretty certain about the cost savings using solar power. So I would probably use close to a risk-free rate of return to evaluate that project. And so I'd probably use the after-tax cost of debt. So let's look at a project. Say a firm's considering the purchase of a new machine to increase revenues for its current existing business lines. All right, so the one I thought about for this project is the Redbox Corporation, the one that offers those CD kiosks. If they want to launch another machine that generates certain revenue and costs, they should probably use their weighted average cost of capital. That is their business. So let's look at calculating the NPV of buying a machine today. I have some sales, cost of goods, and general and administrative expenses. I have a tax rate. I'm going to use the WACC as a discount rate. I'm going to depreciate my cost of my machine over 8 years. And I'll assume at the end of 8 years I'll sell it for $300, even though I depreciate the full amount. So let's calculate the NPV of this project and see if we should do it. So sales are $800. I'll just leave all the numbers positive instead of making negative signs like I sometimes do. So let's say the cost of goods sold. Whoops, I'm sorry. Sales are 1,000. My cost of goods sold are 400. My SG&A, selling, general, and administrative expenses, are 300. And depreciation expense, we'll assume it's $800, and we'll depreciate that machine over 8 years. So I have a depreciation expense of 100. Then I'll take my sales, and then I'll subtract my 3 expenses. So I have earnings before interest and tax of $200. I'll then just subtract off taxes. So we'll take our EBIT times the tax rate, some taxes of $80, and then I'll take my earnings before interest and tax and subtract off $80. So now I have earnings before interest but after tax of $120. In this example, there's no interest mentioned anywhere, so I don't have to worry about interest expense. So we have earnings before interest and taxes. It has no interest expense in there. And then from there, I can calculate the free cash flows to the firm. Now remember, there's a difference between earnings and cash flows. So I can start with earnings before interest and after tax. I can then add back depreciation. And then I could add up those two. And we're assuming no CapEx or non-cash working capital after the initial investment. My free cash flows to the firm at the end of the first year is going to be $220. Now again, that's not counting the $800 today. So if we're doing the total cash flows, we're going to spend $800 today. We're going to then get free cash flows to the firm of $220. I'll anchor that. And we'll assume this project lasts for 8 years. Now at the end of the 8th year, you're going to sell the asset for $300. Now, in all the examples I'm going to use in this course, we're just going to amortize the full amount of the machine over its depreciable life, not accounting for the salvage value. And because normally you would suggest that accountant would say you would actually only depreciate the difference between the cost of the machine and the salvage. But for all our examples, we'll just pretend the salvage is kind of a surprise. We're gonna actually depreciate it down to using a 0 salvage. But in the end, we know we're going to get $300 for this asset. Then we're going to calculate the tax on our salvage at the end of the 3 years. So again, all I'm doing is selling that piece of equipment at the end of its life in this case. Now my cumulative depreciation, I'm depreciating $100 a year for 8 years. It has $800 cumulative depreciation. Now the net book value, which is the cost, minus its cumulative depreciation, has a 0 book value, which means that the full salvage value is taxable. So my after-tax salvage value is going to be $300 minus the tax rate times the difference between the salvage value and the book value. That's shown as a gain. So my after-tax cash flow from the sale of the equipment is 180. So let's put that at the end of my cash flows. Now I can calculate the IRR of this investment and see if we should do it. So my IRR is 23%. If my after-tax, or if my WACC is 15, looks like I should do this project. Now the NPV, using a discount rate of 15%, select the cash flows from year 1 to the end and add the initial cash flow. It looks like the NPV is $246, so I should accept this project. Remember the interpretation. This project demands, based on its risk, which is the risk of the company, I should need a 15% return. This project provides a 23% return, so it's a good project. Another way of thinking about it is if I were to pay off my capital providers who gave me $800, and if I paid them 15% out of my cash flows, I'd have $246 left. That is value created that's going to wind up being accrued by the equity holders. Right? Because the bondholders, they're not going to get extra money. The bondholders or the banks that lend to this company that are included in the WACC, they'll only get paid the contractual amount. So any value, any cash flow above that is going to accrue to the equity holders, either in a form of maybe a capital appreciation of the stock, or maybe you can pay a higher dividend. Now it's just for fun. Let's say at the end, you make the assumption at the end of 7 years, you make the assumption you sell it for only $50. So I have another link here. So at the end of 7 years, even though you depreciate it for 8 years, a full 8 years, I'm going to get rid of my cash flow in year 7 or 8. This is all the same from the last example. The only difference is I'm now using a salvage value of $50. At the end of the 7th year, I've only depreciated $700 as the cumulative depreciation. So my net book value is $800 minus $700, has a book value of $100. So my after-tax salvage value is the 50 minus the tax rate times 50 minus 100. Now, according to the IRS, we're losing $50 on this asset, right? Because I'm selling it for 50 and the book value is 100. So that's going to create a tax shield. That $50 loss is going to mean I'm going to pay $20 less tax elsewhere in the company. So even though I only received 50 when I sold it, I'm picking up a tax shield of 20. So the after-tax salvage is actually 70. I'll add that to my final cash flow, and you can see the NPV and IRR of this investment. So this is a traditional way of calculating an NPV and IRR of a project that has both revenue and cost, and also a depreciable asset. And again, I just want to note that in reality, we should be depreciating the difference between the asset's cost and its residual value or resale value. However, in this course and in the textbook that we're using in this course and most traditional finance textbooks, we'll generally depreciate the entire value. Now let's talk about the capital budgeting for cost-only decisions. What if it's you're calculating the NP, you're making a decision of buying a piece of equipment that all it does, it's only expense, but you need it, right? So you need a heater for your building, all right? Now the heater is not associated with any revenue, you just need a heater for the building. And you have looking at 2 different heaters with different costs and maintenance costs. How you assess the NPV of that project and decide which one you do is you calculate the NPV of total cash flows. However, the cash flows are going to look a little different. Instead of doing revenue minus cost, it's just going to be cost times 1 minus the tax rate. So, this could be the annual maintenance cost of a particular heater for your business. However, if the cost is, say, $100 and taxes are 40%, if you take 100 times 1 minus the tax rate, you only really pay 60% of that. So another way of thinking about that, if you take the cost times 1 minus the tax rate, and I do a distributive property here, which means the cost times 1 minus the cost times the minus tax rate. That is the same thing as this. Minus the cost plus the cost times tax. So whenever I take a cost times 1 minus the tax rate to get the after-tax cost, it's really saying I'm going to pay whatever the cost is, but I'm going to create a tax shield equal to the cost times the tax. So my net cash flow from an expense is really the cost times 1 minus the tax rate. And if I have to depreciate the asset's initial purchase, there's also the depreciation expense, which creates a depreciation tax shield, which is the depreciation expense times the tax. Every cost, even a non-cash cost, is going to create a cash effect on taxes, a tax shield. And then we also handle working capital and CapEx, of course. So let's look at this example. We have a situation where we just broke our copier this morning, and we're sitting there looking at it, and we're deciding, do we just sell the copier and go outsource with all our printing needs for the future, or do we try to fix it and keep it in-house? So here's the example. We could, so in the left panel here is going to be, we're going to fix our copier and keep it copying in-house. The second side is, let's sell that broken copier for whatever its salvage is worth. And then all we'll do is we'll outsource all our copying needs. At the end of the day, we'll just give our copying needs to another firm, and they'll take care of it for us. So let's calculate the NPV of both of them and decide which one we're going to do. Now, if we want to fix the copier, the cost is going to be $17,000 to fix our current copier. If I then if I subtract my tax minus the tax rate times that expense actually creates a tax shield. In other words, the after-tax cost of that is simply 17,000 times 1 minus the tax rate, or 10,200. Because I could have rewritten that in a shortcut manner, minus the cost times 1 minus tax. Now, if I fix the copier, now I have a functioning copier. My expenses for operating that copier are $25,000 a year. I'm also going to, I'm currently recording depreciation expense of that copier of $3,000 a year. That shows up as a non-cash expense, which means that my total operating costs are $28,000. If I take negative tax rate times my operating expense, that's going to create a tax shield of $11,200. So it's really just going to cost me, after tax, $16,800 to run my copying in-house. Now that's profit after tax, or earnings before interest after tax. All right, again, there's no interest expense mentioned here, so let's assume none for now. If I then add back my depreciation, since there's no CapEx and working capital after the initial year, that's going to give me a free cash flow to the firm for years 1 through 5, assuming prices are not changing, of $13,800 after tax free cash flow. Now I could have done this all in one step instead of doing all these numbers. I could have just taken my $25,000 times 1 minus the tax rate, right, plus the depreciation tax shield, depreciation times tax, and I would have gotten the same number. So this is a shortcut method. You don't have to always kind of replicate an income statement and then a free cash flow statement. All you need to do is really just take your after-tax cost and add the depreciation tax shield. Now we can actually then just calculate our NPV of keeping in-house. Right, I'll spend $10,200 today. I'll then generate expenses of $13,800 every year, and I can calculate the NPV by saying equals NPV. I'll click on my discount rate, which actually that should say the after-tax cost of debt. So let's change that to after-tax cost of debt. I'm going to anchor that, comma, put in my cash flows from year 1 to 5. And then I'll add my first cash flow. So the NPV of keeping it in-house and fixing it is negative $59,945. Now what if I outsource it? I'm gonna throw out that copier. Well, I'm gonna sell it to somebody. I've been told that it's worth $5,000 if I sell it today, so I'll get a salvage value of $5,000. If I take minus the tax rate times the salvage value, whoops, we're going to do all one step here. So actually, let's calculate the taxes on the salvage value. If I take minus my tax rate times my salvage value minus the book. Now the book was given to us by accounting, looks like, and the book value of the copier currently is $15,000. So I can sell that broken copier for $5,000. The book value is $15,000, so I'm going to sell it at a $10,000 loss at a 40% tax rate. That's going to create a $4,000 tax shield. So the after-tax effect of selling that copier at a loss is I'm going to generate taxes of $9,000, $5,000 from the sale, and $4,000 of a tax shield. Now I no longer have a copier, and I have estimated that I'm going to spend $33,000 outsourcing my copying expenses. There's no depreciation since I'm outsourcing this, so my total costs are $33,000. I'll then multiply minus my tax rate times the operating cash flow. That could generate a tax shield of $13,200. That gives me a profit after tax of $19,800. There's no depreciation, so that's going to be a cash flow of $19,800. So now I can calculate the NPV of outsourcing. I'll generate $9,000 from the sale, and then I'll spend $19,800 per year. And I can then calculate the NPV. And looks like the present value of all costs of in-house are $59,000. The present value of all costs if I outsource are $62,000. That's the net present value, including the initial value. And so it looks like I'm going to go with the cheapest cost. Since this copier is not generating revenue, but I just still need one in the business, I'm just going to minimize cost. Now, another way of doing this analysis, and the textbook does this sometimes, if I take my in-house minus my outsource. So this represents the decision of in-house minus outsourcing. I could take the NPV of that difference, and you can see I can create $2,400 in value by choosing in-house over outsource. So whenever you have a situation you're taking an NPV of a difference, an NPV of A minus B, it actually tells you the NPV of choosing A over B. But I could have just done it this way, and I've gotten the same number. So you can just calculate, if it's a cost-only problem, you just want to minimize costs or maximize the NPV. In this case, it's a negative NPV, so it's really, when you maximize the NPV, you're trying to find the smallest negative number. So that's our example on the copier. Now let's look at another example of a problem in which it's calculating an NPV where there's no revenue, but there's a cost savings. Now, if you have a cost savings, someone tells you if you buy this equipment, we'll actually reduce our cost in some way. Well, you can treat a cost reduction just like a revenue, right? That cost reduction is the same thing as growing revenue. So we're going to actually treat a cost reduction like we would a revenue. So let's calculate the NPV. We're considering the purchase of a machine that will save $3,000 pre-tax per year. Now you have a choice. You can either use accelerated depreciation or a straight line. We'll do it both ways. And we're going to calculate whether we should do it and then the impact of using an accelerated depreciation. So I'm going to take my worksheet. I'm going to first calculate my depreciation. Now I set up a bunch of named ranges. Notice I have CapEx, life of the asset, savings, salvage. I'm going to sell this thing at the end of year 5, but I'm going to depreciate it over 6 years. Tax, and I put K for the discount rate. We'll assume that's the after-tax cost of capital. So we'll say this cost savings project is relatively risk-free, nearly risk-free. So we're going to use the after-tax cost of debt. So I'm going to take my depreciation expense, which is going to be just my acres percent times the CapEx. I'll copy that down. So this is how I'm going to depreciate my $10,000. If I sum it up, it'll be $10,000. And that depreciation expense, if I multiply that times the tax rate, is going to be my tax savings, the cash flow impact of that depreciation. Now, if I did a straight line depreciation, I just take my CapEx divided by the life of the asset. So if I just did a straight line, I do 1667 a year, which is 10,000 over 6 years. And then I can calculate my depreciation tax yield by multiplying that times tax. So these are the tax savings, straight line. These are the tax savings, accelerated. They're identical. The sum are the same, except this one with accelerated, they're front loaded. All right, so now we're almost ready to calculate the NPV of this investment. We haven't dealt with the savings yet, but let's first take care of the resale. We're going to assume we get rid of this project after 5 years, even though we're depreciating it for 6. So let's calculate the after-tax cash flow at the end of year 5. So we're going to get the salvage at the end of 5 years, no matter if we do a straight line or an accelerated depreciation. Let's now calculate the net book value. The net book value is going to be the cost minus the sum of all the depreciations, not the depreciation tax yields, all the depreciations from year 1 to 5. So, whoops, I took 1 to 6. There's 1 to 5, year 1 to 5. And I'll do the same here, except I got to change the formula to capture this row or this column. So the net book value is either 576 or 1676, whether I'm using the acres or straight line. Now the taxable gain, I'll just take my salvage minus the net book. That's my taxable gain. I can then calculate my tax, that times, minus the tax rate times that taxable gain, 1370. So we did all this work really just to get the tax on our salvage. So if I now just take our salvage and add our tax effect, this is the after-tax, sorry about that, after-tax salvage. We're going to use that below. So now we're ready to calculate the total free cash flows of both acres and straight line of this cost savings project. So the first thing, whatever we use for depreciation, we're going to subtract off CapEx first. All right. Now the savings, we're just going to treat it like a revenue, right? A negative cost is a revenue. So we can just say the savings, treat it like a revenue, say equals savings, times 1 minus the tax rate will be my after-tax savings. And then all I need to do is add the depreciation tax yield, because that's a tax effect. Now the reason I can just add the tax shield is I didn't deal with the depreciation on this left side. Or I didn't calculate, say, earnings for interest after tax. So I can just add the depreciation tax yield. Well, it looks like the tax, not T. So I can copy that down. I'll copy that over. Now this one, got to make sure I use get the tax shield. So I need to move this over to column F, because I need the tax shield, not the depreciation expense. Copy that over. And then the last thing I want to do is I want to add my after-tax salvage value. Add my after-tax salvage value. So these are my cash flows from for this machine, either doing an acres or straight line. I can calculate my IRR, that's always the easier one. 15% and 14%. Now my after-tax cost of capital here is 6%, so it looks like we're going to do these projects. Looks like they're going to have a positive NPV. So let's do the NPV. Equals NPV. Put in my K, that's my discount rate, comma, cash flows from 1 to 5, and add the initial cash flow. So it looks like if I choose this project, whether I depreciate it, no matter what way I depreciate it, the NPV is positive. However, it looks like the best deal, as it always will be, is you want to do the project and you want to do an accelerated depreciation, only because it's going to make the cash flows higher up front because of the accelerated depreciation. So there we go. This is how we evaluate a cost savings. We just treat it like a revenue. And we also talked about how accelerated depreciation can create value. So now we're going to look at a corporate buy versus lease decision. So you need a piece of equipment, and now you're simply deciding whether you should buy it or lease it. And we're going to assume we're doing operating lease, where you just expense it, we don't depreciate it. So the purchase cost of the machine is $5,000 today. You'll depreciate it over 3 years, which will create a depreciation tax shield of the depreciation expense times the tax rate. Otherwise, you'll do an operating lease. We'll assume that the operating lease are 4 payments of $1,500, one today and then one at the end of each of the next 3 years. We'll assume that lease expenses are tax deductible, and again, because this is an operating lease. So let's go ahead and calculate the NPV of both of these situations to decide whether we should lease or purchase. So if we purchase the asset, we will spend $4,000 today. And if we spend $4,000 today and capitalize it, we're going to take a depreciation every year, $4,000 divided by its life 3, and get a tax benefit, a tax shield of 15%. I'm sorry, tax shield of the tax rate times that amount. So we're going to save taxes by being able to depreciate this. And then I'll just put a link there that my cash flows will look like that for the next 3 years. Now, if I lease it, the lease today is $1,500 times 1 minus the tax rate to get the tax shield. So my after-tax lease expense is $900. So these are my cash flows. And then I can calculate an NPV. After-tax cost of debt, I'll anchor that, comma, cash flows 1 through 3. Add the initial cash flow. So the NPV, if I purchase it, is $2,600. The NPV, if I lease it, is $3,178. And if you take the difference, looks like you can save $528 or create value by purchasing it versus leasing it. Or I can take the NPV of the difference. So it's quite clear we want to purchase this asset and not lease it. And by the way, I want to discount this at my after-tax cost of debt because the decision to purchase or lease is just about risk-free. Right? I'm not talking about whether I need it or not. It's really just the decision of how to finance it. So I'm going to discount that at the after-tax cost of debt. All right, here's another interesting problem. So say Disney World or Walmart, who has probably 1 billion light bulbs across their properties, is deciding to switch from maybe an incandescent light bulb, the traditional cheap light bulb, to the the more expensive but long-lived or long-lived fluorescent light bulbs. Now the traditional NPV method of evaluating a project fails when you have projects like this. They do the same thing but different periods. The traditional NPV method fails, and I'll show you that. Let's take a look at our spreadsheet. We're going to calculate something called the effective annual cost, although in this case it's going to be a monthly cost. Effective annual cost. So say our annual discount rate in this case is after-tax cost of debt of 8%. Our monthly discount rate is, I'll divide by 12, 0.667%. And let's assume that electricity is 10 cents per kilowatt hour. A kilowatt is 1,000 watts. Now our traditional light bulb has 100 watts, cost about $1. If we use it for 250 hours a month, about 8 hours a day, those light bulbs are rated to last 1,000 hours. So 1,000 hours over 250 hours per month, it's going to last about 4 months. Now you're not responsible for this calculation, but I went ahead and made the calculation. If it's 100 watts for 250 hours per month at 10 cents a kilowatt, that's going to cost me about $2.50 a month to light our traditional incandescent bulb for 8 hours a day. Now, if I buy the fluorescent light bulb, that light bulb's about $5. but it's only 15 watts. Now, the reason why I'm comparing a 100-watt incandescent bulb with a 15-watt fluorescent bulb, they have about the same amount of lumens, the amount of light. So I'll buy this 15-watt fluorescent bulb. It gives me the same light. It costs me $5, not $1. However, this bulb is also going to last 10,000 hours, and it's only 15 watts. So it's going to last 40 months. And if it's only 15 watts, and I use it for 250 hours per month, it's only cost me 38 cents a month to operate one of these fluorescent light bulbs. And by the way, this is about the realistic cost roughly for a kilowatt hour is about a dime. It varies by state and by region, but you know, that's an average. Now let's calculate the present value, or the net present value of both these bulbs. So if I take my bulb cost, I'll just leave all costs as a positive number. $1 cost me today. However, this bulb is going to cost me $2.50 a month for 4 months. So I'm going to use a present value function. Present value. Let's put in a rate, I'll anchor that, of 8% divided by 12. It's going to last for 4 months, comma. Now I'm going to put a minus the cost. Because then you remember how the present value function, it flips the sign. If I put a positive payment, it'll give me a negative present value. So I'm going to just put a negative there. And what you'll have is the present value of $2.50 for 4 months discounted at 8% divided by 12 plus $1. So the present value, the net present value of operating a light bulb, an incandescent light bulb, for 4 months is $10.84. Now I can, since I anchored the discount rate, I can copy that formula here. And what you see is a tradition that the fluorescent light bulbs are $5 plus the present value of 38 cents for 40 months. So if you're using the traditional NPV form or decision rule, if I want to minimize my costs, I choose this cheap light bulb that only lasts 4 months. The problem was you have to replace this one 10 times in the life of this bulb. So here's 2 ways to do it. The second one is the official way we want to do it, but just to give you an idea, if I take the present value of the life of that bulb and divide it by how many months it lasts, it's about $2.71. If I copy that formula here, $18 spread over 40 months is 45 cents. This light bulb is dramatically cheaper per month. Now, the only reason I don't like this method, it doesn't account for the time value of money. So we calculate something called the the equivalent annual cost or cash flow. And what that means is you would, basically it's like calculating a mortgage payment. If I say equals payment, and I put in this case, the monthly interest rate, I'm going to anchor that, comma, 4 months, comma, and then I put a negative present value. What that's effectively, it's like what payment would I have to pay if I borrowed $10.84 at my monthly discount rate? I'd have to make a payment of $2.75 a month. If I copy that formula, I'd have to make a payment of 52 cents a month. So it's clear, using the effective annual cost, even though this one's monthly, that I want to get this more expensive light bulb. It lasts longer, it's cheaper per month, and it's captured in the EAC. So often you'll have those types of decisions. Do I buy something expensive that lasts a long time, or buy something cheap that's disposable? And this is the way you handle that decision. All right, last thing I'm going to do is NPV and IRR are the 2 most commonly used capital budgeting techniques. There is another method called payback period or discounted payback period. So let's look at this project here. And I'm only giving you this because a lot of firms do calculate it, and in finance we don't like to use it because it doesn't really count for the time value of money, discounting, but it does get used. So let's look at this project. Spend $500 today and generate these cash flows. Here's the present value of each cash flow discounted at our discount rate. So it has an NPV of 133, has an IRR of 1743. Now the other two methods are calculated. Well, it's really one method, payback, but it's either the payback or discounted payback. As you look at the cumulative cash flows, I spent 500 today. At the end of the first year, I spent 500, but I made 200. I'm still 300 in the hole. I copy that formula. At the end of the third year, I spent 500, but I made 300 total, right? So I'm 200 in the hole. So it looks like if I do a cumulative cash flow, the number above plus the new cash flow, it looks like I break even between the third and fourth year. By the fourth year, I'm in the black, right? I'm out of the red. You know, in the red means you're negative. So it's looked like between 3 and 4 years. So what you do is the payback. You look at that last negative year, 3 years, plus the year in which it turns positive, 50 divided by the next year's cash flow. You say my payback period is 3.5 years. So another way of ranking projects besides NPV and IRR is see how quickly they pay the initial cash flow back. Now the other way this is done is to do it on not this column, but on this column. So let me see, I should be able to just copy that across. So this is the cumulative present value of cash flows. And if I do the same logic, using present value of cash flows, I break even between the fourth and the fifth year. So I'll say it's equal to 4, the last negative cash flow, plus what's left over in the fifth year divided by the cash flow in the fifth year. So this one it pays off in about, on a discounted basis, 4.5 years. And then I could do that for another project. So now here are 2 projects, NPVs, IRRs, paybacks, and discounted paybacks. Now the finance theory tells us always use NPV. So it's clear project A is superior than project B. Now here's an interesting case in which the IRR of project B exceeds project A. We're going to assume that both these, since the NPVs are positive, they must exceed their hurdle rate of 8%. So why would I choose A over B? Why would I choose NPV over IRR? That's because we maximize wealth, value. We don't maximize rates of return. We use dollars to buy things we like. We don't use rates of return. So we always value dollars and not rates of returns. As long as the NPVs are positive, I will take the one with the highest NPV. Now also look at these projects. Project B has quicker payback. All right, so IRR and payback are saying project B is better. NPV says project A is better. But again, I will always use NPV, but this is a notion or an idea of how quickly the cash is paid back. I think this measure, payback and discounted payback, is popular because I think a lot of managers don't trust cash flows that are being forecast way in the future. So this project on a present value basis, discounted payback, it takes a full almost 5 years to pay back. This one only takes 2.5 years. So I think some managers might say, well, this might be, it has more model risk, we say. It has more risk in the estimation of cash flows, where this one's going to be paid back really quickly. So I just wanted to throw that out there as another method that's used. So in this topic, we did capital budgeting by calculating free cash flows, deciding whether to discount at the WACC or discount at the after-tax cost of debt. And we looked at revenue-producing investments, cost reduction investments, lease versus buy decision, depreciation decision, outsourcing, and investments of unequal lifespans. Again, we talked about that you generally, if the project has the same risk as the underlying business, we're probably going to use the WACC. And if the project is nearly risk-free, we'll probably use the after-tax cost of debt. We also talked about if you had to rank the projects between NPV, IRR, and payback, I'll generally use the NPV method because we maximize wealth, and the payback and discounted payback don't really account for the time value of money. In the next topic, we'll talk about one other set of investments in which use discount rates that are not exactly equal to the WACC. So we're going to talk about other projects in which you're not going to use the WACC or use the after-tax cost of debt. We're going to use something maybe in between. So we're going to talk about different ways or some other different types of projects in the next topic, and the next topic will conclude our topic of capital budgeting.